Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, March 20th, 2024. I just wanted to get a very brief one out, one quick video, and one last reminder. Today is Fed Day. And as I covered yesterday or the day before, whatever it was, I haven't checked again, but we had a 99% probability the Fed will not change rates, so we know that's going to be a non-event. But what matters is what the Fed says. And most important is how the market reacts to it. And then to add to those comments, not the initial reaction, because I've done this long enough to tell you, you're going to see knee-jerk reactions. You know, the minute the 2 p.m. rate decisions announced, and it could be the one that sticks, or it could go the other way. But quite often, you get a knee-jerk one way, then a rip dip, and we're talking, quite a bit. It could be 1% or more in either direction. It can be 1% or more in the other direction right after. Remember, what tends to happen is the machines trade right away. The algos, computerized trading, high frequency trading, and so they parse through the data and fire off orders quicker than humans can. So just kind of FYI. And I'm saying that because I got, if you're an active trading junkie, I get one more setup out for you. We can try to thread the needle. And then I will, of course, continue to speak to swing and trend traders once the dust has settled. What I mean by that is the 2 p.m. rate announcement then is followed by the 2:30 press conference with Powell. Not always, but quite often you see more volatility, and that's when they're going to get the street will get more clarity on what Powell's thinking and the Fed as a whole. So. The dust usually, it's hard to say, but quite often it's going to be later towards the end of the day, or even sometimes Friday or the following Monday. Remember, today's Wednesday, 2 p.m. By the time, he starts talking at 2:30, it's going to go past 3. Market will almost be closed then. And, I'm just trying to tell you, it's quite often a lot of noise. And sometimes, look, the lasting reaction may be the one. What hasn't changed for me are the key levels to watch, and I'm not going to go over that again. I've covered that so much on Treasury bonds, yellow zone, and then on QQQ. What's that level? I'll get to that one second. I'll recap with those levels at the end. Just wanted to highlight this. The one I fired off to you this morning, right before the open, and I did follow up, as I quite often do, with a QQQ chart with some comparable levels. In fact, QQQ at the time had a very objective entry. I first got this post out here. We rallied into. I'll get to that one second. But what I did here for you, because I've gotten more and more positive feedback. At first, posted, told you what I'm doing in active trading, and couple subs bit my head off. Why is this active trading? We're not day traders. And then I did get feedback that some enjoy it. And, if I don't do a good enough job delineating or differentiating which trades are active trades and which are swing trades, I don't know if I couldn't do anything more other than watermark it with a big giant letters over the chart for active traders only. So again, pass on what's not in your wheelhouse, or your cup of tea. But all right, so here we go. This is NQ, and what I did here is I just measured on that 15-minute chart I've been using lately for active trades, and what you can see here are all the divergent highs and divergent lows. This goes back to the 29th right here of December. So I'm sorry, what am I talking about? This is 29th of February. So that is pretty much, it's almost exactly 3 weeks of trading here. And again, divergent high, divergent low, divergent high, divergent low. This is the most recent divergent high. And so it kind of gives you an idea, the top to bottom right here down to here is a 3.7% range. And so, the way it works is you're not going to catch milk every bit of every run on these. You're not going to, sometimes you can be in, and quite often I am right at the bottom or lows if it's a pullback to support, and you give it a little bit of room there. This is that big support level we've been bouncing on QQQ that I highlighted again yesterday, which is the breakdown level that I'm looking for. I'll get to that in a second when I zoom out to the 60-minute chart and the daily chart. But so, let's just keep it very simple. Let's just say that you've been active trading, you only get 1%. Again, that one was probably 3. That was probably 3 because this top to bottom is 3.7. But let's just say you got 1% on each of these trades. You got 1, 2, 3, 4, 5, 6, 7, 8. You have the divergent low 9. 10, and if this one does play out, let's say for 1%, it'd have to come all the way down here. And to do that, you can either take the quick profits. I have a little sub target right here. I don't know where it went on this. Oh no, it was on QQQ. I put it here. I'm going to give it right there. It's a little minor support if you're looking for a really shallow target, somewhere right about there. But I'll just leave the ones I had on 18,205. Let me get rid of that line. Well, whatever. I'll put it there. I'll leave it there. So there, that's you'll probably come some buyers step in right here first, and then like I showed, the arrows are always on. I draw them in after, and the arrow break is our targets. And the way all targets work, and this is in the FAQ page, and it's obviously very, very logical that the first target has the highest probability of success. So you can just book profits and take the money and run if that's your thing. It's going to be less than 1%, or just that, if you get down to that level, just lower stops depending where you're into. You could have them at break even. The wider the stop, the less likely you are to get clipped out on a reaction, on a little counter trend kickback. But the tighter your stops are, the more you're going to protect profits. So there's that double-edged sword. You figure out what works for you. This is that big level. I'm going to flip to QQQ here. Let's just go ahead and do that. I just wanted to, say that's, what did I say? 1, 2. If you traded each of these divergent lows and divergent highs, the moves that followed: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and if we get it, that'd be 11% in 3 weeks. You can annualize that. And of course, nobody bats 1,000. And speaking of that too, using that baseball analogy, this is active trading or even short-term swing trading. The analogy I like to use is trend trading. In typical swing trading, we're trying to hit a lot of doubles, triples, even home runs and grand slams. We get that sometimes. We get 50% plus trades every now and then, plus, high double digits quite often in just a short period of time. And so that's typical swing trading. Active trading, you're going for singles. In fact, in many cases, you're going for not even that. You're bunting. If you know baseball, a bunt, is a sacrificial play. You got a runner on third base. Sometimes they'll bunt. It's guaranteed they're going to throw the guy out at first, the batter, but that lets the runner on third drive home, so unless the bases are loaded, it's a forced play, so you don't bunt on bases loaded. So anyways, that's how that works, and this is kind of that. You're going for very just short-term little bits, and they add up. Let's look at the other charts. Let's look at QQQ, and as I often do, this is the one I got out to you this morning right after I followed up, either maybe just before, just after the open. That QQQ gave you, we popped, waited to the open right into that 440. Remember I had 440 here recently on the charts, and that was, so that one you didn't have to wait for the trend line break. You had an objective short entry at resistance. And you can see, as always, arrow breaks denote price targets. That's the level I was just giving you on NQ right there that will most likely come into play for a minor reaction. And then there's the big level. It's really 433 on the daily, I'm calling it. You can see down here I had the line at 433.67. So as I often do, I'll follow up, sometimes if I throw something out quick, you don't have time to mark up the charts, I'll get an additional one. So let's look at that. Let's go to the charts, QQQ. There it is. So, you got a short at 440 so far, and it pulled back. You can see right to the trend line. Remember, all these levels are support. So, and again, it's certainly not it's a single. It's a 0.5%. And, you hit support. You're going to come in, buy it, and then when the trend line breaks, which I suspect it will today, most likely, I'll come on down and... didn't I have? Oh, I hand drew that line in. That's what it was on the chart I posted in the comment section. I'll add it right now. 437.22. So that's how it works. Reaction 1, fade that. I'll go on. Next sell signal or objective short entry would be a break of the trend line, take you down to 437.22. Get a little reaction there. Come on down there, and maybe that's it for the day. Who knows? I don't think so. Still have, like I said, negative divergence here on the 5-minute chart as well. Now, bigger picture. Okay, enough for you active traders. This is swing traderville and active traderville, because even when you're trading a 5-15-minute chart, don't ever lose sight of the bigger picture, the 60 and minute and daily, because they're even more important. More traders and investors are watching the daily charts for support levels. And so, as I mentioned here, we've had just multiple pullbacks to 433. It's color-coded yellow. It's a level that I believe once broken, especially if, well after the FOMC meeting, we're below there. That is most likely going to, it's going to sharply increase the odds that these targets will be hit. It's the sell signal, if you will. Now, we've had objective short in. We had a breakdown here of the trend line, a back test. And now this level needs to go. So they're all objective short entries. This is just the higher probability. So it's kind of, a scale-in thing. We've had sell signals here for a while, but that would be 1, 2, 3. And this is kind of, again, for lack of a better word, so it's not misinterpreted, kind of my all-in moment where it doesn't mean my entire portfolio, but just take a full position, swing short, swing accounts. This is where, and I told you I will start to abandon, and I already have cut back on the amount of active trades, the size-wise. I'm just clipping little bits here and there, and that's just what I do. But this is where I'll kind of morph back into swing trading mode, and I think the odds, if we get the sell signals, and if those big mags, most of the mag 7 and the sectors in the S&P, I'm looking, the top sectors are all breaking down. I'm less eager or likely to game bounces or aggressively game them on the pullbacks to the initial targets. When we get down to the final targets, if the charts are constructive to go long and reverse, I will. Now, look, again, I double speak because I wear two hats. I wear active trader hats. So in one account, I might game a little reaction off that level. But in swing accounts, no. If we get a sell signal on 433, I can show you right now. This is a high. This is my first preferred target. This is the first target, meaning I think we get a reaction there. It's a gap backfill. But if you look over here at the volume price histogram, I have my levels turned down on these charts so they're not so busy. You can see a big old thin zone right here. A thin zone means very few trades occurred in that thin zone, but where these bars are real short here. So you had just a swift move up there. And thin zones work a lot like gaps. That once entered, they're usually backfilled. So again, look, we could do this after the Fed. And then everything I'm saying is moot. I'm showing you levels that are setups, technical support levels. If broken, then trigger objective short entries or add-ons. And if they're not triggered, then a setup. Very important. There's a difference between an actionable trade and a setup. Now, again, how you want to do this, I've been building short positions in swing account and waiting for the Fed to be over. Didn't mean to do that. Just wanted to show you those thin zones. And look, you can see how they line up with price support too. I had a couple nice reactions there for T4, and there's a thin zone there too on top of T3. So that's why, and again, it's in the FAQ page, why list multiple targets. I've always done that from day one. I don't know if others do it out there. I kind of do my own thing, but that's that. And like I said, you can game them as you like, and you may not even agree with any of it. I know some on the site don't think the market's going to the moon, and that's fine. And where you can use these levels then is to buy pullbacks to support. If you think, okay, we're going to maybe pull back, and it's right, and then we'll go up and make new highs and beyond, then any or all of these are the same thing in reverse. Whereas, I'm kind of looking at it as of now. Again, we don't even have the sell signal, but we get it. Something along these lines, minor reaction T1, maybe a little bit better reaction T2. We'll see. But I can tell you this too, and let me just say this. This is important. There is a tremendous amount of hot air in this market. It's kind of not the same as 1999, but there's some similarity. It's just different. You can't rule out if something happens anytime soon, a very swift move down that could just blast right on through the initial targets. And then if that does happen, what I'm going to be doing, and I'll get out, updates out to you as soon as possible. I turn my focus back to the daily charts. Remember, I've been talking about, this, a likely top that's going to bring us down in a nice, if you want just one single swing target, if all these multiple levels and active trades are just annoying you or making your head spin, you don't know what to do. I'll give you one right now. Let's see, I need a clean board. I'm going to just use this board. I'm going to put that trend line there. There's divergence right here. It's the 200 days I've been talking about. And I'd say this zone, I'm going to call it a zone that's 395.66 down to about 384.73. It's not a very big zone. It's what I call support zone. Why? Because the 200s come in there, the 200-day moving averages, simple and exponential, and they're also very good price support levels. And it's what I call HPT, high probability target. So if you want the simplistic thing, here it is. Short here, stop somewhat above, measure, here's how you do stops. Let's say you are short now, and then that target, 10% minimum to the top of the zone, 12.6 to the bottom, probably slice through. My guess is we'll be coming down pretty fast and hot if we do, and therefore we'll most likely get what I call momentum fueled overshoot. Even if 395.66 holds at the end of the day, we'll probably. But again, that it's I'm looking ahead, and what I'm trying to do is what very few do. I'm looking 3 steps ahead of something that hasn't even happened, because these moving averages are moving up. Even if we go down one day, they don't immediately turn down. They're 200-day moving averages. A 10-day or a 5-day moving average will turn down fast. 200-day moving averages take a little longer unless you really come down hard. So you can see they're right smack in the middle. So where I was going with that is, so you're talking 10 to 12.5% drop. Therefore, you can give yourself a 4% stop. That would be up there. Certainly, that would be a back test, depending. That's the BOD line. That's the benefit of the doubt trend line. And you could even keep it tighter if you wanted to. But around the Fed, here's the thing. Tight stops are probably going to get clipped in either direction due to the post-FOMC noise. So I'm a little more a fan of a little bit more liberal side. So I think that's probably appropriate, about 4%. Or if you wait for that, what's that key level again on the blue, clean board, 433 to go. Then now that changes a little bit. Then you're talking about a 9 to 12% drop. So then maybe you want about still about a 4, a little better than a 2 to 1, between a 2 to 1, 3 to 1 RR. So those are your levels. There's a trading plan. Take it, leave it. That's swing trader plan. And this morning, what I got out to is active trader plan, and 2 different things. There are many times, many times, almost at a given day, long one thing in a longer term accounts, a trend or investment position, or if you want to call it that, or a long term swing position, whether it's the indexes and then usually it's the index is what I'm doing active trading on, and then I can be short just on again based on this 5-minute chart, divergent lows, you can be long off those divergent lows, short off the divergent highs, and et cetera, et cetera, et cetera. Okay, so the magic number 433 QQQ. I've gone over the levels quite a bit lately on the big sectors of the S&P 500, the yellow lines, XLK, benefit of the Dow trend line. So it's really up right now. It's 204, call it. Let me color it up yellow. Remember, we broke these trend lines, but just like, remember, XLK is almost a mirror of QQQ because it's QQQ is over half, 50% tech stocks pretty much. So it's going to mirror that. That's a big sector. So 204.21 is where I have it. So let's just round down, say 204. Should do the trick. 144.55 on XLV, healthcare sector. This is not as good support. You can see by that, you can see XLK, the tech sector, and this XLV have been really dancing on that lately. XLF, although it's important, the biggest levels I see here are these trend lines. I have the primer in yellow, and I don't know if you can pick it up in the video. I have a BOD or benefit of the doubt trend line here. Catches that candle there, comes off the October lows, that one. And then we had a breakdown candle yesterday, but I also have price support there. So if you want to color it up, let's just do that for kicks and giggles. 40.50, we'll call it right there. And then XLY right there is already broken down. A lot of these are already broken trendline support. XLI industrials is holding trendline support. So that's the yellow level. See, I don't see that important of a horizontal support level. I'd rather this trend line needs to go. And so far we've tested it intraday, but every day closed on it or back above it. That's what that green candle means, close above it, red right on it, green intraday slight, ever so slight cut, but back above it. So these are the things I'm looking for. Those are the top 5 sectors of the S&P when they take out those yellow lines. If QQQ and SPY are also below those comparable yellow lines I gave you, SPY probably going to be 508.35 that does a trick, but I've had, and I'll leave it there, 502.81 is that level there. So, and then of course my Treasury bonds, 10-year IEF, bouncing off. There it is again, bouncing off that yellow. Well, it bounced off yesterday, the bottom of the yellow zone. So needs to see. Why don't I just make that line yellow, because that's the bottom of the yellow zone, and boom. And then this is the bottom of the orange zone. So we'll color that one orange, and that's that. And then the red zone, it just keeps going. All right, I think that's it. Let me pause the video and just make sure I got everything for you. Yeah, that's about it. You know, the VIX, of course, is pretty much an inverse of the market, although the VIX has steadily been walking up this downtrend line I've been highlighting, offering objective pullbacks, and really needs to pop really the recent highs. If you want to have the line at 1573, so we'll call it, it's about 16. I'm just going to leave it there. We'll color it up yellow, but you know, to be safe, give it, you know, VIX is volatile. It gets a little punchy. I mean, it can punch through, briefly spike through support and resistance levels intraday. I know that was the spike high there recently, but this to me, what I see, what I spy with my eyes, this like ascending triangle pattern right there. And so I think a pop above that 16 level should get the party started. And what I can all but assure you, if the aforementioned levels on the indexes and the major sectors of the S&P go, I don't have time. I don't want to get into the Mag 7. I've covered that quite a bit lately, just reference any of the recent videos. But this should go hand in hand. And the way it works is it's kind of like trading GDX, the gold mining sector ETF, in lieu of gold. Because if you buy one or the other, if you're right on your call on gold and gold goes up 10%, GDX is going to go up probably 30%. And likewise, if gold drops and you want to short, gold drops 10%, GDX goes down. It's not a fixed number, but it's usually 2 to 3 times what gold does. So to me, it's a matter of now I'll trade futures. I'm levered up on gold and I have tax benefits there, so I will trade gold and silver futures. But I also, in other accounts where I don't use futures, or at least not at all, then I'll use GDX and things like that. So where I'm going with that analogy is the VIX is the same thing. You know, I'm either going to be right or wrong on a call, you know, a significant market call, whether it's bullish or bearish. And then, you know, I can, and I do, you know, trade the indexes as well, but I also will trade the VIX. My preference is futures. You guys can use the ETNs if you want. I don't like them, especially in taxable accounts. You got the dang K1s to deal with and all that other mess. But and then there's inherent risk too. I've seen these things blow up. There's a couple times where we had, especially, what was it? Not even that long ago. It was after the financial crisis. We had a big drop and a huge spike in the VIX, and a couple of them went bust because they, just the way they're run. Remember, the ETNs are different. They have more risk. An ETN is just an IOU. It's a promissory note, if you will, from a bank that runs it. ETFs hold the securities and can pretty much backed by collateral. This is just a promise from, in this case, iPath. They're using derivatives, futures, and other, you know, derivatives contracts to mirror, kind of mimic the VIX. But if they, for lack of a better word, muck up, the thing can blow up. So it's very rare and unusual. And the only time that happened last time, in a huge spike in the VIX, where it just they weren't positioned properly for it with their derivatives. So then they basically told everyone, sorry, you know, you kind of were closing it down. It blew up, and you kind of lost your money. So there's that. So if you want to trade it, without as much risk, I would assume VIX futures or options on those futures. But to the best of my knowledge, because of the way the VIX works, I don't think there's a VIX ETF. I think there's just these VIX ETNs. No, this one says ETF. I don't know. You have to look at the prospectus, guys. There's a lot out there and too many to cover. All right, let me just wrap it up, get the video out to you guys. And one question that somebody asked before I forget, and yesterday I just went through the comments from yesterday. Somebody asked about Bitcoin and what my thoughts on Bitcoin would be if QQQ does, if we get those sell signals that I'm watching for on the markets and QQQ and IEF. If IEF drops into the orange zone and QQQ takes out 433. My guess is Bitcoin will continue lower. Bitcoin already broke out. I highlighted this bearish rising wedge recently, divergent high. Bitcoin broke down. This is BTC, the crypto itself, and there's your levels. So this coincides with, remember, QQQ just recently checked that 433 level, I believe it was, again, support. And so did Bitcoin, had a comparable support here. You've got a trend line here. And the key is Bitcoin's pretty much most of the time, not all the time, but most of the time, it's a risk-on asset. What that means, risk-on assets rally when the stock market's rallying. Tech stocks, risk-on. Crypto, speculative crap, meme stocks, stuff like that, when the market's in risk-on mode. When it's in risk-off mode, stocks are going down, particularly high-flying tech stocks and meme stock, everything I just said, and crypto. So that's my best guess. And there's the levels. Bottom line is that, they take it out. Then you have next support price and trendline support there. If that's broken, there's your next target. And ultimately, we could come all the way back down to here. But, if the market likes what Powell's selling today, and the stocks rally, then crypto is likely to rally. There's a downtrend line I just drew for you right there if you're looking to get long, and there's support right there also if you're looking to get long. So you can, again, when you mark up a chart, you have support and resistance levels. That's first and foremost, and then you have to decide which way you think it's going to go and react and position accordingly. All right, let me wrap it up here and get the video out to you guys. This has been Randy Finney with the Right Side of the Chart. Have a great day.